Happy Friday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Friday, May 31st, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro events is a healthy U.S. consumer, slowing U.S. inflation, bumpy European inflation, and fourth turning presidents. In terms of market implications, the May PC report supported both our resilient U.S. economy and Jay wants a soft landing themes. That said, the high probability of slowing income and spending growth over the medium term likely dooms consumer discretionary stocks to continued underperformance. Although Eurozone inflation accelerated and surprised consensus expectations to the upside in May, we do not see that outcome as having a significant impact on the ECB's policy outlook. European real and nominal growth dynamics are in a sweet spot for continued European equity outperformance. It does not matter who wins the U.S. presidential election because both candidates are fourth-turning presidents that are likely to perpetuate faster growth of U.S. sovereign debt than consensus expectations. The likely monetary response of that outcome supports our structural bullish bias on risk assets and structural bearish bias on defensive assets. Investors will have to manage risk along the way if they want to avoid significant drawdowns in their portfolios during liquidity, business, and/or positioning cycle downturns. Transitioning to our 42 macro dashboard here. We'll always, as always, we'll wrap up with the question from our community. This one reads not ETH, around the horn liquidity cycle metrics from our. So we did a deep dive on the liquidity cycle in last Saturday's Around the Horn webcast. So I'll read the question here. It says, "Hi Darius, the recent Around the Horn was fantastic. You are constantly one-upping yourself. Very impressive. I know from experience not to miss a minute of the presentation because you're prone to drop great knowledge nuggets throughout any moment." Appreciate that. So the question is regarding specifically slide 64, which was our global liquidity cycle monitor, in which we helped investors comprehend historical and current liquidity cycles, as well as how asset markets have performed both on the upside basis and also on a max drawdown basis within those liquidity cycles to help investors understand, okay, where are we in the current liquidity cycle? What kind of return should we expect throughout the duration of the liquidity cycle? And lastly, what kind of downside risk could we potentially experience throughout the duration of what is currently a liquidity cycle upturn? So getting back to the question, says, curious if you think there would be value in looking at this regularly to compare to prior cycles, or if you think it would be more appropriate to view it in a different way. So the answer is absolutely. In fact, we included that table in today's leadoff morning note in terms of helping investors contextualize some of the treasury indigestion that we've seen this week. And then lastly, going back to the question, if the liquidity cycle upturn continued to late 2024, early 2025, it seems as if there could be significant upside risk left. But at the same token, the longer it continues beyond the upturn median return, the less likely it is to continue. I guess this is why you say this is the hard part to risk manage. And it's not why I say it, it's why Paul Tudor Jones said that like 30, 40 years ago, which is the last third of the move is always the hardest part to risk manage. Last third of the move in a market, last third of the move in terms of the business cycle, last third of the move in terms of the liquidity cycle. These are always the hardest parts to risk manage. The easy, making money in financial markets is never easy. But the easier part of risk managing any cycle is the first 2/3 of the cycle, the last third of the cycle, where you're starting to have the markets are starting to sniff out a potential top or bottom and start to inflect. That's when you start to see more dispersion across signals, and it makes it a little bit harder to stay long or short in any given trade. So this is, so we understand that. We understand that we're, kind of in the latter innings of this liquidity cycle upturn. We also have some other important conclusions from that analysis, particularly from a left tail risk perspective that I think is very important, but we'll keep that embargoed for our paying clients. So we'll wrap it up there. Darius Dale presenting our macro minute for Friday, May 31st, 2024. Everyone have a wonderful day out there. Best of luck. Everyone, wonderful weekend, and we'll catch you back here on Monday. Cheers.